The market is trading right back at the big bad weekly resistance trendline that defined the bear market for most of 2022. We tried to run, we tried to hide. Does the market have what it takes to break on through to the other side? That's the million-dollar question for today's episode. What's up, traders? This is, of course, the weekly watch list, where I will be doing a full technical analysis of everything that you see listed up above. And make sure to stay tuned until the very end, because I've got 3 additional trade ideas to share with you. As always, anything that we're associated with is linked down below in the description. A quick thumbs up on the video goes a long way to support the channel, and with all of that said, let's dive right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this past week, we've certainly got a solid-bodied green bar with very minimal lower wick, and even if we do want to read into it, it would just suggest that the buyers stepped up off of the lows, and where were they able to close? Right up at the highs of the weekly range. So from a structural perspective, buyers definitely have the win here. If we think about location on the bar-to-bar count, we certainly produced a significant higher low as well as a significant higher high. So to me, another check mark for the bulls in the past week's worth of trade. Now let's not forget, as we pointed out in the intro, of course we have to contend with the big bad weekly resistance trendline. But the first video of 2023 outlined 3 particular steps that were required to change the weekly trend, and 2 of them have been completed. Number 1 was recapturing the hammer high from here. That's been done. Number 2 was getting back up inside of the prior weekly balance, recapturing the lows. That's been done as of the past week's worth of trade. And number 3, all that's left is breaking possibly the weekly resistance trendline and weekly 50 SMA, the blue moving average on the screen. I would also suggest that because we are coming off of a higher low and because we are retesting the resistance trendline in short proximity of time, instead of coming from a lower low and instead of almost doubling that time to retest the trend line, we have higher odds of breaking the trend line. Again, it speaks to bullish improvements, not necessarily a full-blown weekly trend reversal just yet. We could easily break this, put in a double top, and possibly rotate back down to the downside. And a clear example of this, because everybody loves making these comparisons, and I think they're worth looking at, let's go back to the dot-com bust of the 2000s, right? Early 2000s. If we sketch in that same weekly resistance trend line coming in something like this, you can see that we've got lows, we've got the higher lows, we break the trend line, but what happens? We put in the double top, and of course the rest is history. That's where the last sort of leg lower from the bear market really comes from, right? So that certainly is a possibility, but once again, we're speaking to improved bullish odds if we can get above the resistance trend line. So back to the present day, let's check in on the high volume node. We are back above this, so no longer does it have the opportunity to act as resistance. That is a bullish step in the right direction. Now it could possibly offer support. And just like we talk about rotating through a thin volume void on the downside, we can also rotate through thin volume voids, low volume voids on the upside. The next volume resistance shelf is really much closer to SPY 420. Again, not making the suggestion that we go there the upcoming week, just pointing out where resistance is. We can also start to think about higher time frame inverted head and shoulders. If this ultimately plays out and we break the trend line, that would be a break of the neckline of this particular pattern. And again, I'm not suggesting we go here the upcoming week, but if this is the measured move, stacking that on top gets us right back within striking distance of the all-time high. Just trying to keep an open mind to better than expected outcomes for the calendar year of 2023. Let's go on down to the daily time frame chart and check out some more pertinent information for the upcoming week's worth of trade. What do we see from an expected move perspective? Certainly bullish in my estimation. The upper edge is right around 405 and the lower edge is around 392. If we make it and are contained by the upper edge, it's of course a higher high and also suggesting a break of the weekly resistance trendline. That to me would be bullish. Don't get me wrong, we still have the opportunity for a lower high from here to here, but the more time we spend in this balance area, the less meaningful that becomes. Of course, if we're contained by the lower edge, it's clearly a higher low far above the prior balance that we were concerned with throughout the sort of second half of December of last year. So expected move does strike me as bullish. I also want to be very clear that we've adjusted a level down here to 390.350 instead of 394.50, and that's most clear on the hourly time frame chart. It still clearly represents the lower edge of the balance from this area, but of course we always favor the more recent price data. Look at how exact this is. Prior resistance turns to support there on the Thursday session, support there on the Friday morning session as well. It's 393.50. While we're on the hourly, I would also just reiterate that on Thursday, the sellers were unable to really accelerate prices back down underneath this prior high. On Friday, even though we gap lower in the prior day's range, we accelerate on the open in the upward direction. So sellers sellers not really taking advantage of the multiple instances they had to push prices in the downward direction. Let's go back on up to the daily time frame chart. We've got our first daily close over the 200 SMA. And as we've been pointing out in prior videos, the odds of this head and shoulders pattern unfolding are decreasing the more daily closes that we get back above 390, 350. If we are going to be in store for some bullish patterns here, bull flag consolidation ultimately just holds over the high volume node from the weekly time frame chart, which would be 389.50 right around in here. It's right around the lower edge of the weekly expected move. It's the gap up from Wednesday. It's also the daily 50 SMA at this point in time. Holding that area does strike me as bullish. The bears have much more work to do. If this is going to flip in the downward direction, bears want to see prices closing underneath 385.50 back inside of this balance area. And of course, the threat would be a breakdown of 279.25 to get down into the weekly equal lows at 355. Obviously, we've seen some major improvements in the upward direction. That does not strike me as being a high probability outcome into this shortened trading week. Let's have a look at some Fibonacci's. If we come in with the fibs from the high of this move to the low of this move. Remember that we were concerned about the 38.2 keeping us in bear flag consolidation. That is obviously off of the table, but what I also want to point out is now we have a daily close over the 61.8, which generally starts to improve the odds of making the 100% retracement, which would be the equal high closer to SPY 410, getting almost in line with a break of that weekly inverted head and shoulders neckline that we were just discussing. So you can see that there have been some clear bullish improvements based on the price action over the really the past week, right? Sellers not really accelerating here. Buyers continue to step up. We're holding above key areas of prior resistance. Speaking of prior resistance, let's have a look at the anchored VWAPs from 2022 dips, right? All of the dotted ones are from 2022 dips. This seemingly was going to be a tricky area. We're up through that now. Now that we're above this area, it should be more likely that people who have bought the dips of 2022 are trying to add to their positions instead of close their positions, right? They have reason to add now that they're seeing green in their portfolios. We're above the anchored VWAP from here, so the dashed ones, the more elongated anchored VWAPs, are a little bit different. This white one is coming in from the CPI print from December. We're back above that. That was possibly offering confluence of resistance in the zone. We've recaptured it. This dashed one that's pink up here is the all-time high, right around the upper edge of the weekly expected move. So once again, if we do see continuation through the resistance trend line, I don't really think that there's reason to be chasing longs here. I think some consolidation into a bull flag would be most healthy, build out something that looks like this, and then possibly start to attempt the upper edge of this range from in the past, 2020 or all-time high anchored VWAP. And then the last one that might be a little bit more difficult to see, perhaps easier if I turn off the drawing set, the anchored VWAP from the breakout bar of this balance right here. It's the orange dashed line, and any pullbacks that continue to hold this area, lo and behold, it's right around that critical area of support, right? There it is, mixed in with the gap, mixed in with the lower edge of the weekly expected move. Anything that continues to hold that does strike me as bullish evidence that there are steps in the right direction for a possible breakout of the weekly resistance trendline. So lots of bullish data points going on here on the daily time frame chart. Again, for the bears to really see something impressive happen, they've got to get it back down underneath this big area of support, which is why we pointed out just a few moments ago that they need to see the print underneath 385.50 to get back to more of a bearish stance on this particular market. Let's have a look at our internals and see if these are confirming anything that's going on here. Apologize as I load that up. Top right-hand corner's got you covered with a brief tutorial if you don't know what this screen is. Overall, absolutely. I think that the internals are definitely confirming the breakout that we've seen from the balance area. All of the volume inflows have been positive, although things are slowing down as of Friday. That's going to be a theme to pay attention to here. Again, I don't necessarily advocate for new money longs just yet. I think a bull flag consolidation period over the shortened holiday trading week might be a constructive look for the market, and then a break, and the lack of, or the less aggressive inflows, I should say, as of Friday might be starting to signal, hey, there's less aggression in the upward direction. We shouldn't be pushing our luck on the higher high. Wait for the consolidation, wait for the higher low pullback, and then look to enter the uptrend, right? You can see that in the advanced decliner as well. Really positive on the Monday session, Tuesday, Wednesday, Thursday as well. Friday has to recapture the zero line coming all the way from negative 1500. So don't get me wrong, it was really bullish that it was able to recapture, but it does start to indicate that things are possibly slowing down. Really bullish builds On the cumulative for Tuesday, Wednesday, Thursday, notice how it's still bullish, but not quite as much as of the Friday close. So overall, internals are supporting much more of the bullish action that we're seeing. But with Friday's slowdown, it may start to be time to look for a higher low pullback or continued consolidation. This market profile chart is going to support the same idea. If you don't know what this is, top right-hand corner's got you covered with a brief tutorial. This is the big concern, the fact that value area did not shift higher with price on Friday. Pair that with the weakening of the internals, pair it with the fact that the point of control actually migrated slightly lower. I'm not necessarily sure that I would be so gung-ho about buying these highs. I would wait for consolidation. I would wait for a pullback. Once we develop some sort of range, maybe that's where we look for the next breakout over some clearly defined level. We've also got a little bit of a spike forming on the Friday session here. So spike rules will be in play early on in the week. If we open above, we're looking to auction higher until we find sellers. If we open in the spike, you're just watching the high and the base of the spike. And if we open inside of range, expect more balance. I would also, lastly, on the market profile, there's a lot to talk about here. It's really a dynamic market out there. Look at the lows. Decent prints at the lows here. Good excess indicates the completion of the auction. Notice that we were also repaired the poor high from the Thursday session. So really not much structure to look at and say, okay, this is deficient. We should get a break here. We should get a break there. It's really all about the fact that point of control is neutralizing. Value was not breakaway to the upside. Things are slowing down a little bit here at the upper range of the move that we've seen over the past week or so. Let's get back on over to the platform and have a quick look through some sectors. I'm just going to go ahead and throw back on the 50 and 200 SMA. Here we are. So weekly performance, I would just like to point out that the XLY took the cake. Gold medal there up 4.5% on the week. Really, really impressive, noting that it was such a laggard as we were sort of breaking down from in here, and it never really participated in the October rally. So the fact that we're starting to see some relative strength there does strike me as being bullish. XLK is towards the top of the list. XLC is towards the top of the list. At the bottom of the barrel, we have the XLV and XLP, which are both D for defensive sectors. So the posture out there is definitely becoming more bullish as well. The structural charts will continue to light the way. XLY, again, look at the improvement getting back into the range instead of clearly rejecting for some sort of lower high. The fact that, once again, sellers did not give some aggressive selling on Thursday. Friday, right as we sort of opened towards the lows, it's not like they took control and sent prices back lower. We actually closed a bullish engulfing bar here. Big improvements in the XLY being much more of a risk-on sector. This strikes me as a bullish data point for our market going forward. Now, of course, there's the risk now that we can get a pullback, and we just want to make sure that we get a higher low. Ideally, somewhere above 135 would be, rainbows and butterflies for bulls, but as long as it's above 130.75, as long as we do something that looks like this and get back inside of this overhead range, I would say that that's still a bullish data point for our S&P 500. Next up is the real estate sector. Has much more to do with the wealth effect breaking out over the 39. Definitely much more of a bullish indication here. More consumer spending, probably healthier for the economy as a whole. A little bit more macro when we're dealing with real estate. XLK, the tech sector, the heaviest weighted sector of them all. 2 days now, recapturing the overhead supply lows at 129.50. Again, is it okay if we see a higher low pullback? Absolutely. In a picture perfect world, this either consolidates or gets a further push in the upward direction. That way a higher low could form somewhere around, the line in the sand is 128.25. If we look at the hourly, you can see here, prior resistance turns to support, and we're above it, of course, as of the Friday session as well. So picture perfect world is something that looks like this. Not so picture perfect world is still something that does that. And a concern for the XLK would be a rotation back down underneath 124.50. So far, a decent improvement. Remember, we're still talking about improvements in all of the sectors here. This is meaningful, being the heaviest weight risk on sector. XLC, again, speaks for itself. Look at where we're at in terms of the range. Straight shot from the bottom to the top. Even if we get a pullback, high chances that we get some sort of higher low. Looking for a break at the top of the range here. And the target, of course, is the overhead gap. It does strike me as a bullish force for the market. XLB for the materials sector, again, right up towards the highs. Hard to say that this isn't bullish. Strong possibility of a higher low than a break that looks like this. Overhead, the next area of resistance is around 88. Unfortunately, lightweight sector, it's not going to mean a whole lot for the market if it starts to break out, but it will be a bullish force. Don't get me wrong, if it does go. Next up, we've got the XLF coming out of bank earnings on Friday, and we've got more to come this upcoming week. We'll talk about earnings in just a moment. This strikes strikes me as really, really healthy, right? We opened on the gap down. We repair the structure by closing the gap and then close over the Thursday high. A bullish engulfer after earnings sent us on a gap down, in a tumultuous market environment. That to me is a really, really solid sign of strength. Again, chasing the highs up here for new money longs. I don't know about that on a 100% retracement, but overall the feeling of this chart is definitely more bullish than bearish. Strong odds of either continued bullish consolidation somewhere in this area for a flag and then break, or even a higher low. Again, it can really afford anything over 34.50. Next up, we've got the XLI. What's going on in industrials? 8% of our S&P 500. The story is going to be mostly the same for all of these sectors. Look at how we're getting the bull, cup and handle here. You could just isolate it into the flag portion here. Continued higher lows over $100.55. Beautiful. Looking for continued upward pressure for the S&P 500. It becomes meaningful on the breakdown when and if we get back down underneath 99. Next up, we've got the XLE for the energy sector. This is D for defensive. This is risk off, as we've been calling it. Notice here's a range. Here's the midpoint of the range. It's not really aggressively breaking the top. It's just kind of playing nicely in the midpoint. As we'll see in the ratio grid, it's not outperforming. This is exactly what we want to see for our market. So that's a bullish data point. The same thing holds true here with utilities. D for defensive. Here is an overall range. It's smack in the midpoint. It's not accelerating. It's also not breaking down aggressively, because let's not forget, downward pressure is still downward pressure for the S&P 500. The fact that it's sideways strikes me as positive for the S&P. Next up, we've got the XLP itself for consumer staples. Same idea. Here's a balance range. Here's half of the balance range. It's playing nicely here. It's not breaking down aggressively. It's just going sideways, which is exactly what we want to see out of the defensive risk-off sectors if there's going to be a passing of the baton, so to speak, back to risk on. Next up is the XLV for healthcare. Continues to just go sideways in the range. It is the second heaviest weighted sector, so we need it to participate in upward rallies, but nonetheless, it's the defensive of the heavier weight sectors. So to see it going sideways doesn't strike me as the end of the world. It would be a much bigger deal if financials were stuck sideways, if tech was stuck sideways. Those are the sectors that need to outperform of the heavyweight sectors. XLV gets the hall pass, so to speak, in terms of lagging the overall market move. Let's go on over to our ratio grid now and just have a look at what's going on. Reminder, top right-hand corner's got you covered. If you don't know how to set this one up, I've got you. So XLK, XLV, XLFY, all the risk-on sectors are the top four. Remember, we're speaking to improved bullish odds. We're not all the way there from a risk-on perspective yet. XLK needs to get over the 50 SMA here. XLV is pulling back. We just went through the spiel on why it's acceptable there. Notice that the XLF is starting to find a higher low, and the XLY is still in a counter trend move until proven otherwise, but looking really good, starting to interact with that 50 SMA, the gold line on the screen. Notice that the XLP is falling off of a cliff. That's a good sign from a risk-off perspective. So bottom four of the risk-off sectors. This continues to look good. So do utilities. Remember, they're not outperforming as they're going sideways in that range. Same thing with real estate going sideways, energy going sideways. Really solid looks here in the ratio charts. And just for some context as well, let's have a look at the yearly grids. So notice that the XLK did not put in a lower low here. That strikes me as a decent look. XLV is still clearly in an overall uptrend. If we zoom out and give ourselves some context, XLF, same idea, in an overall uptrend here. This is the one that needs to flip, of course, the XLY. Notice that your XLP is breaking back down, so a fake break, so to speak, of this area. We've been talking about this on the weekly time frame charts. Not going to pull that one up, but so far looking more like risk off is phasing out, right? And also notice that the XLU is putting in a lower high here. Again, risk off, phasing out. Overall improvements in the ratios, not, really not maintaining much of that bearish look. Let's have a look at growth versus value. So growth versus value. Again, excited to bring you these updates as we've broken the weekly, or not weekly, but the resistance trend line, the daily 50 SMA, 2 prints now, 2 days worth of prints over that 50 SMA, the gold line there. This is looking like it's improving. Again, doesn't speak to, going to the all-time high tomorrow, but better odds of breaking that weekly resistance trend line the more that this ratio starts to improve. Let's have a look at our dollar. What I would point out in the Dixie is the meaningful breakdown here, and it honestly looks like it could go lower considering that we've got a possible 3-bar play here. We've got a big red breakdown candle, a resting bar on Friday, looking for continuation in the downward direction, and this is supported. If we take a look at gold, GC, look at the power of this breakout here. Really, really strong in the upward direction, certainly supporting that the dollar should move lower, which of course is bullish for equities. This of course is something that the Fed does not want to see. They don't want to see sort of financial conditions loosen reason they want them to remain tight. So I wouldn't be surprised if they send out some of the Fed speakers to sort of talk markets down, so to speak, over the next week or so's worth of trade. Let's have a look at rates now, speaking of the Fed and what's going on there. Look at the threat of the breakdown here. So again, weekly lower high. All we've got to do is crack underneath 34.31 in the 10-year, and that of course would confirm the start of a new downtrend, which should be bullish for the tech sector, the heaviest weighted sector of our S&P 500. So once again, the Fed does not really like this, but based on the technicals, it's suggesting that the chart could head lower. Let's have a look at the TLT, just because that, of course, has a direct relationship with the rates here. And you'll notice that, yes, they are finding that kind of higher low, and of course, it's just an inversion of the TNX. But what I want to point out is the fact that the relative performance has not been, outperforming the SPY. And with no outperformance in the SPY, it would be indicative that no one's really looking for that flight to safety type trade. Therefore, if equities are going to move, they should move significantly because no one's sort of hedging against the possibility of a new breakdown in the S&P 500. So not seeing that flight to safety. And if we take a look at the HYG, which is, of course, your high yield, this is, well above the prior high here, just indicative of a strong risk appetite out there in the market. Now, what is the market pricing in for the Fed watch tool? Here we go. Notice that we're still calling the Fed's bluff and saying, all right, 500 is the terminal rate, 500 basis points, and we're still pricing in some sort of rate cut by the end of the year. The Fed really has to come out and give us a 50 basis point rate hike in the next meeting if they're going to maintain credibility and sort of bring the hammer, so to speak, and knock markets back down. If we look at the current probabilities, it's a 93% probability that we get the 25 basis point rate hike. So, all these Fed presidents keep saying higher for longer. We might dial it back down to 25 basis point rate hikes, but it's going to continue to go past 500 basis points. The market is not buying it. Now, something that we need to start keeping an eye on is the Q4 earnings data, right? And as of right now, it's very, very, very early in the sort of cycle. But right now, we're coming in at 81% beats. Remember that the typical is somewhere around 66%. So we're actually outperforming on the beats. Now, a lot of this will have to do with forward guidance, but remember that the rate cuts coming in possibly late 2023 are to hedge the bet against an earnings recession. All right. So we're going to continue to monitor this in the upcoming week's worth of trade. We've got this. Where are we? Right. 16th. Here we go. Right here, we just sort of kicked off bank earnings. We're going to continue to get bank earnings really on the Tuesday session. And then some tech starts coming in, right? Netflix is always up first. We get Tesla sprinkled in there, Apple as well, AMD. Those guys will start to report somewhere in here. They didn't release the official date, but it's well upon us, earnings season. So once again, we'll be monitoring this to see if we do ultimately fall into that earnings recession. Let's go back on over to the platform. And I want to talk about the business cycle, which we've brought up in a past couple of videos here. Notice that although we are seeing improvements in equities, commodities certainly have not broken down from the descending triangle. So that's going to continue to be on watch. And remember that this can easily get hit in the downward direction if we start to see these earnings come in with big, big misses, especially in the tech sector. So again, not this upcoming week, but the following week as tech starts to report, it should be really, really important and critical for the market going forward here. Speaking of sort of the macro, let's have a look at the unemployment rate. I just want to briefly discuss that this has not spiked. And, typically what it takes for a big drawdown in the market is some sort of spike in unemployment. And I would just remind you, although we're seeing these headlines out there in the news that Amazon has laid off, 10,000 plus workers, let's not forget that they employ around 1 million people, right? So 10,000, again, if you've been affected by layoffs, by no stretch of the imagination am I trying to be condescending, but it's just a drop in the bucket to lay off 10,000 workers, right? It's not really a significant portion of the workforce. We're going to monitor this chart very closely to see if we get any seasonal sort of discrepancies. Like once the sort of holiday hiring is not reflected in the data, if we get an uptick here, that would start to become more meaningful. But as of right now, it just simply hasn't happened, right? And typically preceding a bear market drop, you need to see some mass unemployment. So as of right now, this is actually healthy, still continuing to support more of the bullish data. Let's have a look now. What do we want? We want the new highs versus new lows, right? What I want to sort of point your attention to in this chart is the fact that new highs and new lows, the difference between them is looking the best it's looked in over a year. Throughout all of 2022, we never really got many impressions over the zero mark. We're kicking off 2023 strong with a solid rotation above zero. So it doesn't speak to, again, the market rotating immediately back to all-time highs, but it's a clear difference from what we were used to in calendar year 2022, where we had all of these negative impressions. Some really solid improvements have been made here. Once again, it's susceptible to dipping back down under the zero mark, but it's much less likely to produce something that looks like this coming from all the way up at the top. It speaks to odds, not guarantees. When we're also looking at market breadth sort of indicators, we can have a look at the SPX A200R, companies in the S&P trading above their 200 SMA. Notice that we diddled a little bit underneath the 50% mark, right back up towards these highs. Again, speaks to more companies across the S&P 500 getting and staying above. This higher low here represents staying above their 200 SMA. And we can even look at the 50 SMA equivalent as well. Notice that we get stuck around the 50% mark and we resolve this in the upward direction. Remember that this is all happening during the balance area right here. If the market broke down, obviously it would have, it looked something like this. The fact that these balances didn't break down, the fact that the 50 SMAs are holding out there across the S&P 500, again, much more of a bullish data point. We started to get a little bit contrarian when things are up around the 0.9. You can see these prior highs here and here definitely correlate to the sell, and here the sell as well. We're not all the way there yet, so I wouldn't be a contrarian yet on this one until we get into some of those upper elevated areas. Let's have a look at our volatility indicators. VIX is up first. Really, again, across the entirety of all the data points that we look at, we should have some confidence or at least respect this bullish rotation a little bit more. This is the first time we've traded under 2050 or significantly under 2050. And again, almost over a year. If we just back this off by a little bit, this is the lowest we've been. Here's 2022 start. For the majority of 2022, we were well above. So the fact that this is breaking down, getting some acceptance underneath, has to strike me as much more of a bullish data point than a bearish data point. If we take a look at the VVIX, even as well, volatility of the volatility index, it remains floored. It's not in a big divergence up here around 103. It's definitely perking up a little bit, but that's of course due to the VIX itself coming in quite rapidly over the past couple of trading days. It does open us up to the flood effect, the complacency effect, where if we do start to see, let's talk about the possibility of that double top scenario we discussed on the weekly time frame. If that happens and all of a sudden the market takes out, so to speak, the neckline of that pattern, that's where this will take off. That's where your VIX will spike. Obviously, you get that flood effect. Everybody's rushing into SPY puts, VIX calls. That's where the outsized moves start to take place. So be mindful of that. But so far, volatility not showing us any signs of really much fear out there in the marketplace. Same thing with our futures, right? VIX futures continuing to fall off of a clip deeper into Contango, less risk in the present day versus out there in, the future somewhere. And that is what money managers like to see. Same thing represented here in 9-day VIX versus the monthly VIX. So overall, volatility coming in aggressively, some really big bullish improvements out there across many of the data points that we track. Let's wrap up the broad market with our QQQ and IWM. Notice here that there's still an opportunity for a lower high underneath 281.25 in the QQQ. The most important level into the coming week is that number, 281.25. If the market can get above that and put in bull flag consolidation here, my goodness, the Qs in the Nasdaq tech confirming sort of a bullish rotation, really powerful for the market. If it starts to put in a lower high and break down, this is where we should be, big red alert for our market. This is a terrible, drawing of a alert box, but big red alert if we get a massive divergence between the SPY and the QQQ. If we get high, lower high, and this rotates back down underneath 270, something's not sitting right. Maybe we're in store for more of a neutral outcome in the market instead of the bullish beat that, it's sort of looking like could be brewing as of right now. So 281.25 is the number to beat. If we just stay consolidating here, call it for what it is. A bull flag is a bull flag. Breaking those highs definitely gets us over 281.25. It becomes more meaningful if we start spending time underneath 274. 274, here it is on the hourly time frame chart. You can see prior rejection, support there on the Thursday session. As long as we're above, it's the bull flag. If we fall underneath, more susceptible to making the move here. Let's have a look at the IWM, Russell 2000, and the small caps. Let's go back on over to the daily time frame chart. Zooming in, possibility for a double top. So once again, I want to talk about this rally slowing. We're very bullish here, right? We're bullish talking about these data points, the improvements in the sectors, everything from the breadth indicators and the fundamentals that we just looked at. But let's dial it back a bit. Let's come back to reality. Let's go back to the technicals. If the IWM slows at the top of the balance here, it has acted as a market leader for the entirety of this rally. don't be surprised if the S&P digests and goes sideways. If we build out these bull flags, fantastic. It's going to give us better risk-reward entries for possible upside rotations. Notice you could put a stop here. You could start to target some of these upper levels, right? Overall, the digestion towards the top of this prior range, if we stay in the weekly expected move, does strike me as more bullish than bearish. But again, let's call a spade a spade. If we get here and we start to pull back, it would of course represent that the market may be in store for some pullback and some consolidation. So we're looking to buy higher lows. We're looking to buy equal high breakouts. Chasing the higher highs right now, might not be the most wise decision. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every time a new video comes out. And with that, we will dive right into Apple. What do we see here from a technical perspective? Continuing to hold on to that 130 level, which was prior resistance, was prior support in here. As long as we're above it, technically threatening bull flag consolidation for a small break up and over 135 to get to the back test of the breakdown point here at 140.25. Be mindful of the blue line here, 50 SMA on the daily time frame. So again, key levels to watch. Breakout over 135 as long as we're over 130, continuing to consolidate underneath 130, definitely back down in the bearish chop zone here. The threat would be underneath the lows at 124.50. Next up, we've got Netflix. Leaving this zoomed out for just a second, just to point out that we're at the equal high, which is also representative of the gap close area, and we've come all the way from the lows straight up to the top without any meaningful pullback. The next overhead target is coming from this area of prior resistance at 352.50, but zooming in, again, inverted hammer on the Friday session. If we crack that low, it opens up the pullback into 311.50. Anything that supports off of that, hard to argue that we're not still in an uptrend. We've got start back here, lows, higher lows, higher lows. Higher low could be produced anywhere over 311.50. It would also respect the hourly structure. Having a look here, prior resistance, then clearly turns into support. So I want to see that continue to hold if we do see the breakdown underneath Friday's low. Just continuation in the upward direction. Again, your target is 352.50. Next up is Tesla. What's going on with the untouchable? Don't get me wrong, still on a very strong daily and weekly downtrend. However, Friday's action strikes me as almost somewhat tradable just because we opened on a gap down. The sellers don't really take advantage of that. It should have been a gap red under green. No one runs away with it. Longs don't close out. And we close up towards the highs once again, threatening a break of this resistance area at 123.75. Looking for once again a squeeze over that. Didn't really materialize on the Wednesday session. Let's see if the second time's the charm. So 123.75, next level of resistance is at 137.25. And again, untouchable back down underneath 113.50. Next up is GOOGL. What's going on with Google? Having a look here at the daily time frame chart, some bullish improvements getting out of this balance range and two higher lows respecting that on Thursday and Friday. Technically closing above the two-day highs as of Friday's close, but the daily 50 SMA, the blue line, is putting some downward pressure. So continuation is the more likely outcome here as long as we stay above 89.50, looking to get on board with bullish setups for the back test of 94.65 and then reevaluating that, of course, represents the lower edge of the prior balance here. For bears, you want to see a look above and fail. Once again, it's already done it once here, back down underneath 89.50. Certainly the lower edge of the range could be in play at 86.50. Next up is Metaverse. What's going on with Zuckerberg's Fantasyland? Continued strong breakout in the upward direction, back-to-back patterns unfolding here. So look at 1, 2, 3 breaks out, right? Now let's go 1, 2, inside bar, upper 50% of Thursday's range. 3 possibly breaks out and gets us to the next resistance at 141.75. Just like Netflix, this has come from the lows all the way to these prior highs, prior resistance without any meaningful pullback. So it might not go this time around, but again, watching that level, 137.50, break is to 141.75. If we do get a pullback, the line in the sand for the higher low would ideally be above 128.50. Next up is NVIDIA. What's going on with NVDA? Having a look at NVDA, you can see we've recaptured the daily 200 SMA, solid breakout on the Thursday, Friday move. Look at the lower wick from Thursday. Let's go to the hourly chart and illustrate here. Big push lower, sellers absolutely failed to take out this area of support and we closed strong. So buyers in control. Again, any healthy pullbacks want to maintain 160.75 at this point in time and just looking for upward lift, right? Ideally, this consolidates, gives us a bull flag setup, and then gets the break through this thin structure into the retest of 181.50. For bears, you of course want it back down underneath 160.75, and then when we get there, it's the flush of that hourly support that we just saw, much closer to 153.50, right? Right around in here. Breaking that down opens the door for you guys into the lows. But as of right now, buyers definitely look to be in control. Microsoft, what's going on with Softy? Daily time frame chart. Same idea as almost everything that we've talked about. Bulls are starting to make a stand, but in this one, we're kind of at a tricky zone. Remember that this was prior support, a little bit of resistance there after the break. Could it offer resistance once again? Absolutely. Daily 50 SMA is mixed in as well. 239.25 is the level to beat. Could it be a 3-bar play? Technically, we have an inside bar as of Friday's close. Taking out these highs, you're looking for the rotation higher into 247.75. Prior resistance from this zone here as well. And let's just go to the hourly. The hourly is so helpful, guys. Look at this little intraday pattern here, and then perfect break and retest on the level. That's why we're counting that as significant, right? So that is the upside level in Microsoft. Anything that continues to consolidate here, you possibly still have the opportunity for a lower high being put in place, but bears only get excited if we take out 230.85 on the downside. It's the 2-day inverted hammer upper wicks that never ever even came close to materializing in the downward direction. Earnings around the corner on this one as well. Last but not least, we've got the mini beast. What's going on with Amazon? Again, only a fraction of that workforce getting laid off. Heart goes out to anyone who did lose their job or is about to lose their job in the current environment. But looking at the chart, keeping it objective, we have a break at the top of the range, right? Very hard to argue that that isn't bullish, especially after the start of what looked like a pullback on the Thursday session. So to me, looking for continuation, but chasing new money longs might be a little bit difficult. I would definitely only play intraday patterns on this one. If we do get back down underneath 96.85, higher lows want to form above the daily 50 SMA and back above and inside of this original balance right here. So something that would do this, beautiful. From here to here is your higher low. We respect the balance, and we can look for the entry on the pullback. If it continues, let it float away like a balloon, looking for resistance on the retest of the overhead gap around 104. You know the deal. Hit all the buttons, the like button, the subscribe button, the bell button, and let's get right into these trade ideas. AM Dizzle, inside joke, is up first for our ideas. What do we see here? Inside bar after a hammer candle gap close on the Thursday session, watching for the 2-day highs to break and rotate up into this area here. If we throw on the level, notice how it perfectly coincides with prior resistance, prior support as well, and the target would be the high in here for a day trade, much closer to 75 flat. So over 71.50, target 75.18. Of course, in play as long as we're over that daily 50 SMA, the blue line. Next up is SQ. What do we see in SQ? Very similar inside bar after a hammer candle setup. And look at these prior highs. They all align beautifully at 72.50 roughly. If we get the break, targeting the prior high from here, as well as the daily 200 SMA at 75.75. In play as long as we don't violate the low of the lower wick from the hammer candle. Anything that's just a continued inside bar, building pressure, building a bull flag at the top of the range, looking for that break over time. Next up, last but not least, we've got Starbucks. What's going on with Starbucks? Bullish engulfing bar on the Friday session, completely swallowing all of this consolidation in the upward direction, just looking for continuation. Ideally, in a picture-perfect world, this stays above 106.50. If it comes back in a little bit, that's all right. You, of course, would just want to see a higher low anywhere above 105. You wouldn't want to trade 105, but you would want to stay above it to some degree and then get another sort of thrust in the upward direction. Looking at resistance, though, for a target, let's go ahead and grab some more time here. We've got to sort of scout the next area of resistance. I would say it's probably the lower edge of this prior overhead balance from here on something like a weekly time frame chart, much closer to 109.50. So about a $3 move available in the upward direction if we do see continuation out of Starbucks. That's going to wrap up today's episode of the Weekly Watchlist video. If you enjoyed it, let me know down below in the comment section or by giving the video a thumbs up. Don't forget that the market will be closed on Monday in observance of MLK Day. And with that said, I wish everybody a green trading week.